Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, I'm going to give you 3 companies that are down bad. And I mean real bad. But I actually like these companies for the long term. So think like 3 to 5 years. So let's go ahead and jump into the context of the list, how I came up with the list, and what I am thinking going into it. So what I wanted to do is give you a little bit of context that is going on. So one, we know the stock market this year is down 16% so far. Today was a good day, but we'll see what happens the rest of the year. And every company out there isn't necessarily responding, every stock out there rather, isn't necessarily responding to the way that they probably should. So for example, I've brought this up over and over and over again, but I just like to crystallize this. A company like, let's say Target, that dropped 25% after earnings. A company like Netflix that dropped, I don't know, 20%, whatever it was in a single day. Like, come on, there are some obvious mismatches where the market overreacts to a company, and that makes a discount to you if that company is quality. So what I'm going to give you is 3 companies that I like that are mismatches. The market is down 16%, but you're down 30 or 40 or even 50%. That I think is a mismatch. That could be a dip worth buying. Now, generally speaking, I don't go look for companies that are down 20% or more. And honestly, I don't have a benchmark, but I don't go look for companies that are significantly less than or have underperformed the S&P 500 by a significant margin. However, everything in the market feels like it's down, and there are great companies. I would say, Google, that's down 25 up some odd percent, even though they're fine, right? But hey, I think that's a mismatch. But these companies are down even worse than that. So let's go ahead and start. And one other thing I'll give you is that I'm doing this list in terms of first what I think is the least risky, and then going to what I think is the most risky. But also remember, risk versus reward. So the first one, I don't think it's going to make you the most money of the 3. Do I think it will beat the S&P 500? Yes. But will it be, I don't know, 500,000%? No, I don't think so. But let's go ahead and jump into it. So the first one on here is Nike. Nike's down about 34% this year. The reason why Nike's on the list, other than the fact that it's down 34% in so far this year, is the fact that I don't expect Nike to go out of business. I don't think you do either. Now, there is a case to why Nike could continue falling, and that is the case for anything this year, but especially with the stock market. You never really know what's going to happen. Nike could go down to 40%. I'm not here to tell you that this is the perfect time to buy Nike, but I am saying that while Nike is down, it might make a lot of sense to start accumulating some shares here and while it is down, because again, it ain't going out of business. And the biggest thing about Nike is I don't see the same threat from the competition as other companies. So for example, you have, let's say, Netflix. I know I keep picking on Netflix, but it's one of the easiest ones. Netflix has an extreme threat from Disney Plus. It is an extreme threat from all of these other streaming services. Netflix is struggling. Okay, now I'm not saying Netflix is going bankrupt or anything like that, but you see it and I see it. Where it's like, oh, I have way more streaming choices, and Netflix is raising their price. I need to decide what I want to do, right? I don't see that for Nike. Yes, Lululemon is out there. Yes, I don't know, Skechers and Adidas and all these other shoe companies out there, Under Armour being another one, but I don't really see them threatening Nike in the same way that Netflix is getting threatened by others. Yes, they're different businesses, but I just want to really illustrate that point. I don't see Nike being afraid of their competition in the way that other companies are. I could argue that Walmart and Target are in a deeper competitive battle with Amazon, right? I see those 3 as fighting for supremacy more than Nike is with their competition. Ain't no comp, right? There's nobody messing with Nike today, and I think over the next 5 years, that's going to remain the same. Okay, so I think Nike is one of the better ones out there, but I don't think it's going to make you the most on the list. The next one I think will make you more money in the next 5 years than Nike, and that one is Nvidia. Nvidia is down 42%, and it really doesn't make all that much sense as to why. Now, I understand that as a whole, with the raising interest rates and just the way that tech companies have been treated this year by Wall Street, that they're down significantly. Again, 42%. I think that's a little extreme. Now, the only reason that I would ever think that Nvidia should be down is if, I don't know, we stop using computers and we stop driving cars and we stop using electronics for which their chips are made for. And that's not the case. Now, yes, there is a chip shortage that has hurt companies like Ford and GM and Tesla to a degree, which Nvidia makes chips for that stuff too, but still, there's no reason it should be down that far. And that one of the best points that I can bring home to you was earlier this year, I think it was January or February, they announced earnings. The stock fell, but they said they had the best quarter they had in the last 10 years, which means business is still good for Nvidia, but the stock market just does not like the stock itself. And again, that is, in a market like this, that's relatively common. Microsoft is fine. They're hiring more people. They're paying people more. Their stock is down too. So there is a mismatch here. I think this one is more significant. Whereas, like, I like Google, I like Microsoft, y'all know this. Those are down maybe about 20 or 25% a piece. This one's down 42. I think if I'm looking to make the most money, buying where it's so low over the next 5 years, I think you're really going to get paid from that. Now, I do already own shares of Nvidia. I do own shares, my son rather owns shares for Nike. So just to be clear there, I'm whether or not I buy Nike, I'll see. Well, moving day is coming up in June, so I'll start to make some decisions then. But if I'm looking to make the most money, at least out of the two, Nvidia would be the one I'm going for over the next 5 years. Now, last one, we're stepping it up a bit in risk. But before I do, just to give you context over the last 5 years of how they performed over the S&P 500. Number one, does not predict the future, okay? Especially 5 years. So I'm not using this as to say, hey, last 5 years you made 400%, the next 5 years you're going to make 400%. Not saying that, but I do want to give you a little bit of context to understand how these companies in the past have performed compared to the market. So for comparison, last 5 years, Nike gained, it made 106% compared to the S&P 500, basically the stock market, at 65%. So I would have made 106% compared to the market at 65. So when we talk about beating the stock market, Nike has done that in the past, and I think it could do that over the next 5 years. But then, remember I was talking about how they compare to each other and why I think Nvidia can make a little bit more, actually a lot more. That is because Nvidia was up 376% over the last 5 years. And I think, and we know that generally in an up market, technology usually leads the entire stock market sector. When things get back to normal, when we're done with rate hikes and we're done with the threat of recession, that I think things will kind of go back to what they used to be. When things go back to quote unquote normal, I would assume that Nvidia would be somewhere among the top in terms of stock market performance. So that's those two. What's the last one? The last one is SoFi. SoFi, I think, is the riskiest one here, okay? So if you are looking to swing big, if you're into those types of things, I think SoFi might make a lot of sense. Now, SoFi, let me double check this real quick, just make sure my numbers is right. So far this year, SoFi is down 54%. Now, is this the worst stock out there? No, we've got some that are down 60 and 70%. So it ain't the worst one. It's not the worst one in the block, but I think this is one of the worst with the best potential. And again, I specifically am giving you a 5-year time horizon here. So while I, yes, reevaluate my portfolio every 6 months, which is a practice I think most people should do, I would not really assess my performance here. While I would obviously check in on the stock and the company and make sure they're okay, I would not really grade myself or say that this was a good idea or a bad idea until 5 years from now. Okay, and the reason, there are a lot of reasons why. We did an entire video about SoFi and, you know, the benefits and drawbacks from it. But I think they have the best potential in terms of where they could go in banking, where they're going with their technology platform, and where they are in the market. Like, I understand why the stock is down, especially with the student loan crisis and that student loan moratorium. That's going to be resolved supposedly by midterms, whether positive or negative. I would assume they're going to get over that hump by November, and we're going to have that question answered. That's one reason why the stock has taken such a hit. But in either case, I don't think where they are right now is permanent. Another thing too is because they do personal loans, and they may even get more into business loans and into banking. Once we see the threat of recession kind of dissipate, which may be until 2023. Okay, it may not be before the end of this year. We would all prefer that to be the case. But let's say that we keep doing interest rate hikes and the threat of recession continues to be around the corner and it's going to quote unquote last until 2023. I still got 4 more years for this to really pay out. So that's why I'm kind of zooming out and giving myself a 5-year time horizon to come back and really say, hey, this was a good idea or not. So again, it's the riskiest one here, but I think they have the biggest green space and they have the best spot to succeed. Now the thing that you want to remember is, I think that while I do not currently own any shares of SoFi, I think SoFi is in a good position in terms of having lost the honeymoon phase. They've gotten the polished really stripped off of them from the IPO. For example, and I'm not comparing SoFi to Facebook and what Facebook had been able to do, or Meta now, whatever they want to call themselves today. But remember that when Facebook came out, when they did their IPO, I think it was in 2012, it absolutely flopped. It, at the time, was one of the worst, most embarrassing IPOs ever. And up until this year, it had been, after that IPO, one of the most successful IPOs ever. People are like, wow, Facebook is incredible. It is like the best thing from a stock market perspective. And I'm not saying SoFi is the same, but when SoFi had taken off from their IPO, they've definitely crashed since. And I think that it ain't much further down that they can go. And again, it can still drop further. So I'm not saying that this is the perfect price to get it. I am saying though that between now and the next 5 years, I think SoFi will be way more expensive in the next 5 years. So if you were to get it at $5, $6, $7, $8, whatever it is today, that 5 years from now, you could look back and say, hey, that was a really good decision for me to make. But again, it's the most risky here because that could totally not happen, right? There are a bunch of things that could happen in 5 years. I mean, there's a bunch of stuff that have happened with Twitter in the last 3 months, right? So definitely things can obviously change. But again, I've got Nike down 34% today. I've got Nvidia down 42%, and then SoFi down 54%. I like them all, but if I really got to put my money on it, which I already have, it's Nvidia here. That's the one. That's really kind of my approach in life, is not to be on either extreme, not to be overly conservative, not to be overly aggressive, to sit right there in the middle and really have like an even keel on what's going on. And I think Nike is the safest one for obvious reasons. I don't think they're going anywhere. Product we all understand, but I think Nvidia is probably the best spot. One, I already own it, but also two, I really don't see technology going anywhere. Where the banking sector can evolve and change, and it's also down 54%. Nvidia is the one that's like still doing well right now, and it seems like the biggest overreaction of all three. So Nvidia would be my absolute favorite. SoFi, if I'm really trying to go big, and maybe I'll get SoFi. We'll see. And come June, we'll see what I do. I'm not sure, but I do like the company. Feel free to go back and watch that breakdown of it, because it's SoFi is better than what I thought it was. I thought SoFi was a joke. It is not. So these are my three stocks that are down bad, down terrible. If I were just to look at the numbers and say, look at these companies, if I'm trying to make money this year, it is not what I would invest in. Okay, but if I'm trying to make money in the next 5 years, these are three that I would definitely have my eyes on. All right, let me know what you think in the comment. Is there one that I missed? Are there some that you already own, or some you're currently looking into? I would love to hear your thoughts. Also, I recorded and did the video on Amazon. I had to figure out YouTube's platform to make it an exclusive video for y'all, so definitely stay tuned for that. All right, let me know what you think in the comments below. Talk to you later. Bye.